Welcome to Investing for Profits. My name's Nate. Today we're going to be talking about stock market investing 101. We're going to be covering off what a stock is, what a share is, are they the same or are they different? What is a stock market and what is a stock exchange? Again, are they the same or are they different? So with that, let's get into it. Also, make sure you stick around to the end. What we're going to be doing at the end is talking through a bit of an example of how all of this plays out, how each of these terms work together to end up with someone buying and selling shares or stocks on a stock exchange in a stock market. So what is a stock? What is a share? Quite often you'll find these terms are used interchangeably. People will use them in the same context and meaning and referencing the same thing. Are they the same? Well, they're very, very similar, especially nowadays where we have less and less physical stock exchanges and most transactions are done electronically. For the most part, they are referencing the same thing. Are they different? Slightly. What are the differences? So what is a stock? A stock is really a reference to ownership of one or more public traded companies. As an example, what you might hear someone say is that they have 5 stocks in their portfolio. What they're really saying is that they have 5 different companies held within their portfolio. So what are shares then? Shares are simply a reference to having ownership of a company. As an example, I have shares in Alibaba. I have shares in Alphabet or Google. I have shares in Tesla. I have shares in BHP. The other difference is that stocks are related exclusively to publicly traded companies or securities listed on a stock exchange. Shares, however, could be any magnitude of things. It could be a share in a limited partnership. It could be a share in a real estate company or a real estate venture. It could be shares in a privately traded company. So the stock market and the stock exchange, are they the same or are they different? Again, they're very similar. A stock market is really an umbrella term that's used to represent a place to buy and sell and transact within a region or a country. A stock exchange, on the other hand, is the actual marketplace and infrastructure in which the buying and selling of publicly listed companies takes place. What this means is that all of the stock exchanges within a region or a country combine together to make the stock market. The stock market works very, very similar to what you would expect to see at a fruit and vegetable market. There are people that go there with their fruit or vegetables or maybe possessions that they've made, that they go there to sell their things, to sell items, to sell fruit and vegetables. There'll be other people that come exclusively to buy and they're looking for those same fruit and vegetables knowing that there's going to be someone else selling them. It works exactly the same. The stock market, there are people that own publicly listed companies and shares in those publicly listed companies, and they'll be looking to sell their share in that company so that someone else can buy it. There will be other people that are coming in with cash that are looking to buy a share in that same publicly listed company and will essentially transact those shares in exchange for cash. What it allows people to do is to come together or meet to buy, sell, transact their shares in publicly listed companies. They don't need to be there in a physical sense. They need access to the internet through their broker, stock exchange. They will be able to. And what the stock exchange does is it enables liquidity. So it enables the ability to buy and sell and make sure that when you're looking to sell something, there's someone to buy. It can't guarantee there's someone there, but what it does do is it makes sure that anyone that is looking to buy will have access to those shares that you're trying to sell. The stock market also makes sure that pricing is fair. It does this by making sure there's lots of participants taking place for buying and selling, and that if someone is looking to sell their shares in a particular publicly listed company, that everyone that's looking to buy will have the same access to those shares. Really important to give confidence in making sure that there's fair pricing for any publicly listed company that's being purchased. I do use the term fair pricing really, really carefully. Fair pricing just means based on supply and demand. The more demand there is for something, the higher it's going to sell for. And that's a matter of supply and demand. If there are limited number of watermelons and there's lots of people that want to buy watermelon, the chances is the price of watermelon is going to go up. Likewise, if there's an abundance of watermelons and there's not many people that want to buy, well, there's going to be competition on pricing, driving that price back down. So fair pricing just means that based on supply and demand, you're getting the right price. What it doesn't mean is that that publicly listed company is good value to buy. All right, so now that we're through the basics, let's jump over onto the computer and have a look at a bit of an example. Now here we have an example where we've got stock, ABC company. Insert any name of a company that you want here. So Tesla, Alphabet, Alibaba, whatever that might be. So the stock in this example is ABC company. We've got shares of 100 per person. In reality, we could trade and buy and sell and transact any number that we wanted, that we owned, or that we could afford to buy. For the purpose of this example, I've listed it as 100 per person. The stock market, insert country here, US stock market, Australian stock market, Chinese stock market, whatever it is that you want to reference. And the stock exchange, XYZ, New York Stock Exchange, NASDAQ, ASX, whichever one that is relevant to that stock market or that country or exists within that region. What we've then got that exists within this stock market is both buyers and sellers. So when the market opens, what happens is as we move forward, we will have buyers and sellers that start to come into the market that want to buy and sell and transact. So in this example here, we've got a buyer that's come in wanting to buy ABC company at $45 and a seller that's willing to sell at $55. We then get another buyer that comes in wanting to buy at $48 and a seller wanting to come at $56. At this point, we don't have a buyer and a seller that is matching, so there's no transaction that takes place. We get a buyer that comes in wanting to buy at 50 and a seller coming in at 54, so that gap is closing. We get another buyer that comes in at 47, so coming in lower than the highest bid, which is $50. And a seller now who's come in at 52. So we've got someone that's wanting to sell at 52 and someone that's wanting to buy at 50. These two need to meet before the transaction actually happens. Keep in mind, this can be happening from anywhere provided there is an internet connection. So we don't need to have all those people in one location. Then we have someone that comes in that wants to buy at 52. We had someone that was selling at 52 and someone's come in now at 52. So that transaction would go through. The buyer would hand over the funds, $5,200. The seller would get $5,200 and the shares and the certificate for those shares would be passed from the seller to the buyer. This will all be done through an intermediary, so it's not necessarily a one-for-one for that buyer and seller, but from a conceptual point of view, that transaction goes through and there is a handing over of cash for the share certificate. We then get another seller that comes in at $53, so we've got a difference here with someone wanting to buy at 50 and someone wanting to sell at 53. We have another seller that comes in at $50. That transaction would go through $5,000, which is $50 times 100 shares per person, would be passed over to the seller, who in turn would pass their certificate of 100 shares across to the buyer. Again, an intermediary will do all of that. In reality, we don't have situations where we have 100 shares per person who are looking to both buy and sell. That's why we need to make sure that we've got highly liquid markets, and that's the purpose of the stock exchange, to make sure that there's lots of buyers and lots of sellers. So if someone wants to buy a parcel of 1,000 shares and there's people that are selling lots of 100 shares, that there's enough liquidity in that market to be able to transact, so that buyer can take their 1,000 shares or buy their 1,000 share parcel and the sellers can also sell. The purpose here in this example is really just highlighting and trying to show that transactions won't actually take place unless there is a buyer willing to pay the price that a seller is wanting to sell for, and that a seller won't get that price that they're looking to sell for unless there's someone that is willing to purchase the shares at that price. Well, I hope that was really beneficial for you. If you have watched this video, you have learnt something today, please leave a comment down below. I'd love to hear from you. Also, if you've watched till this point, I'd love you to give the video a like. And if you want to see more of this type of content as we continue to progress through the different investing strategies and different ways you can transact in the stock market, please subscribe so you don't miss any updates. Thank you so much for watching through to the end, and as always, happy investing.